the quick commerce, staying with the quick commerce space. In fact, we have Swiggy that is in the spotlight. That share has scaled fresh life highs. It has moved largely fueled by the brokerage notes that keep trickling in every day, and their bullish stance, of course. But what's the rationale behind it? Well, my colleague Snehi is standing by to paint a comprehensive bull versus bear picture for us. Over to you, Snehi. Take it away.
Absolutely, I'm going to be talking about why Swiggy makes for a good bull case, while Sharad is here to talk about the bear case. But let's talk about the bull case first, Sharad. There's massive opportunity in the quick commerce space. Food delivery penetration can still improve. This is what brokerages are believing. Swiggy will benefit from the accelerated dark store expansion plan that they have before the end of the year. The pickup in the quick food delivery through Bolt is also going to be a further fillip to the company. They've also been rolling out new features like Swiggy One Black, Swiggy Bolt, and they have also forayed into the live event space with Swiggy Scenes.
Well, yes, Snehi, you did tell the entire bull case, but I have a stronger bear case. First one is the competition, the biggest name, Zomato. Over there, they are launching out products, new products before even Swiggy or any other competitor is coming. Apart from this, also the consumption slowdown. Now, that's a bigger problem for everyone. So that itself is an inherent risk. Apart from this mega hub strategy, Swiggy is actually working on that. And this could actually potentially compromise their quick commerce strategy as well. So multiple strategies happening in a single time. So that's a question mark. Cash balance is significantly lesser than Zomato. Let's just go the numbers. That's roughly Zomato after the QIP raise is roughly 18,000 crore. But Swiggy is just having around 8,900 odd crore rupees. So of course, bull and bear case, we are going to be going deep into it as such.
Yes.
Snehi?
Absolutely, Sharad. Now time to look at these bull and bear cases on individual metrics as well.
Well, yes, and I think the most important thing whenever we look at a new age tech company is profitability.
Absolutely.
And the most important thing, it's not profitable yet.
That's
the single line
Swiggy is
itself.
not profitable yet, but they have given an outlook on when they expect to be positive, EBITDA positive at least, the adjusted EBITDA positive by Q2 of FY27. So we do have visibility, we do have a timeline on that front. Profitability even for Q2 has seen improvement, and quick fixes will also aid margin expansion. Also remember, Instamart's rising scale should drive better brand commissions and ad revenue. On the back of that, profitability is also expected to improve, Sharad.
Well, but let's get back to competition because that's my strongest point. The first one being Swiggy has been an early mover. We give you that credit. But it has been overtaken in most of the operational parameters when it comes to Zomato. And they are ahead of the orders, stores, restaurants. As an analyst, whichever segment we track as an operational parameter, most of them Zomato is winning them. Apart from this, also Instamart's EBITDA losses, I want to point that out. Over here, they have widened despite the GOV growth acceleration, and still the contribution margin, if you look at it, that has also come down. Now, Blinkit is having more dark stores also, and it's better take rate than Instamart, and these are the operational parameters for quick service.
Yes.
And couple of numbers also, Blinkit is having roughly 791, and while Instamart, the number is still less, coming in at 609.
But Sharad, what brokerages are flagging off is this entire competition is not needed in the first place, because while Zomato is the leader right now, they say that Swiggy does not need to catch up with Zomato in order to be good in terms of operational performance. And catching up with Zomato is not necessary for a successful investment case, is what CLSA believes. Axis Cap also says that Swiggy has a slightly higher take rate than Zomato. That is one space where Swiggy is beating Zomato at 21.9% compared to 20.8%. And Swiggy's fixed costs have also fallen 13% between FY22 and the recent Q2 that went by. Fixed cost, Sharad, is now even lower than Zomato's for Q2.
Well, Snehi, there is, apart from two competitors, there's a third competitor now. That's Zepto. And
absolutely.
that we have to address that elephant in the room as well. And now you can see the market share pain over here. That can actually come for Instamart also. You can see a significant portion. Blinkit is having 46%, 29% Zepto. If you combine them, it's roughly, you could say, 2/3 of the market. And also, if you see the market share of this quick commerce, that itself will be a very important thing to track, Snehi.
Absolutely. Just to sum it up then, JM Financial also believes that Instamart has immense potential to grow. And in fact, you have Axis Capital that places Swiggy at number 2, even above Zepto. So we have quite the contrasting views coming in from brokerages when it comes to the quick commerce market share for all of these three players, Zomato, Zepto and Instamart. But on that note then, Sharad, it seems like it's quite the balance tilt coming in when it comes to the bull versus bear case on Swiggy.
Well, yes, it's very confusing, and we'll just leave it to our viewers, whether it's a short-term bull case or a long-term bear case or vice versa. But it's very confusing, so we leave it to you.
Absolutely, Snehi and Sharad, you both can fight over Zomato versus Swiggy, but the fact is Swiggy is actually up 29% since its IPO price. And also yesterday when we saw Axis Cap note coming in, they see a 20% upside on Swiggy. On that note, viewers, it's up to you to decide where this war goes.
If you like this video, then like, share and subscribe to ET Now.